So if you're a SaaS founder, you definitely know the feeling, right? Your growth is looking strong, but the whole fundraising path just feels like a maze. Well, in this video, we're going to show you how you can choose the right path for your business. We're breaking down 5 key debt financing options that can actually fuel your company's growth in 2026. And the best part is, you don't have to give up a huge slice of your equity. For years, the story has pretty much been the same. If you want to grow, you need venture capital. But is giving up equity, a large piece of your company, really the only way to scale up? Well, the funding landscape is changing. The hard data from the first half of 2025 tells a really powerful story. While venture capital was facing some serious headwinds, investors poured a staggering $124 billion into private debt funds. This isn't just some small trend. It's a massive shift in where the smart money is actually flowing. And that creates some amazing new opportunities for founders who know where to look. So, what does this all mean? Well, it creates this weird paradox for founders. The SaaS market itself is strong and full of opportunity, but the traditional funding environment has tightened up significantly. VCs are way more selective, and that leaves a lot of great companies scrambling to find the capital they need to go out and capture their market. And that brings us right to the heart of our video today: understanding how to utilize non-dilutive financing. We're going to dive into some powerful alternatives that let you grow your company without giving away a huge chunk of it in the process. So let's just quickly look at the 2 paths that most founders try first. Over on the left, you've got your traditional bank loans. The problem there is that banks love hard assets, tangible things like buildings and equipment, and most SaaS companies just don't have them. They don't really know how to underwrite a loan based on your recurring revenue. Then on the right, you've got your equity funding. It's the classic route, but it always comes at a cost, and potentially losing control over your own vision. So if those old school routes are blocked or just don't feel right for you, what's in the Modern Founders Toolkit? Well, here we're going to break down 5 specific debt financing options that are practically tailor-made for SaaS businesses with sticky revenue. First up, we've got internal funding and convertibles. This is often the very first money that comes into a company. We're talking loans from founders, friends, family, maybe even board members. It's usually structured as something called a convertible note, which is basically a loan that says I'll convert into equity at a later date, usually once the company raises a more formal funding round. But there are 2 big things to watch out for with convertible notes. First is subordination terms. If they're written too aggressively, they can actually block you from getting other kinds of debt down the road. Second is the maturity date. Some of these notes come due in just 12 or 18 months, and if you haven't raised that next equity round by then, you could suddenly be on the hook for a massive repayment. Moving on to option number 2, we have the revenue-based term loan. This one is super straightforward. You get a lump sum of capital up front, and then you just repay it with fixed, totally predictable monthly payments over a set period. There's no surprises and no guesswork. What makes this so perfect for SaaS is the collateral. Unlike a bank, the lender secures the loan against your recurring revenue, which is your company's most important asset. So your house is not on the line and you have no personal guarantees. The payments are predictable, which makes financial planning a whole lot easier. And the interest rate might be higher than a traditional bank's, but it's almost always way cheaper than selling off a piece of your company. Moving on, we're going to be covering revenue-based financing, or RBF. Now, at a first glance, this sounds a lot like the last one, but there is a crucial difference. With RBF, you still get that upfront capital, but your monthly payments are flexible. They literally go up and down with your company's revenue. So just to recap, a revenue-based term loan has fixed monthly payments. That number doesn't change. With revenue-based financing, those payments are flexible. They're tied directly to your monthly revenue. This is a very critical difference, and it has a huge impact on how you manage your cash flow. Revenue-based term loans are ideal for startups with $200,000 or more in annual recurring revenue. Companies with seasonal or lumpy revenue, on the other hand, might benefit more from revenue-based financing. When you have a great month, you pay a bit more, and in a tight month, you pay less. Its goal is to align your debt payments with how your company is actually doing. So now let's move on to option number 4, AR factoring. So to put it simply, this is just a loan based on the value of your accounts receivable. It's a way to get cash today for the money that your customers already owe you, but won't be paying for another 60 or 90 days. Now, here's the interesting twist with AR factoring. Approval doesn't just depend on your business. It actually depends heavily on the quality of your leads. If you're selling to big, stable Fortune 500 type companies, lenders see that as very low risk. So in a way, your customer's creditworthiness becomes your asset. That brings us to our fifth and final option, which is one of the newer tools in the shed, the MRR line of credit. This is a revolving line of credit, just like a credit card, but the borrowing limit isn't just some arbitrary number. It's typically calculated as a multiple of your monthly recurring revenue, often somewhere between 3 to 5 times your MRR. It's important to note that a line of credit is a specific tool for a specific purpose. It's best for short-term working capital needs, like bridging a gap. It's not optimal for large, long-term growth investments, like a major hiring spree. Because if you don't pay it back quickly, it can get very expensive. And founders should be aware that many lenders will require a personal guarantee, so it's crucial to read the fine print. Another thing to be aware of is that some lenders will label their products as revenue-based financing, but really what they're offering you is a short-term merchant cash advance, aka an MCA loan. Understanding the difference between these two loans is critical. True growth capital, like revenue-based financing, is designed for long-term investments, like hiring your next key salesperson or funding a big marketing campaign. A cash advance is really for plugging immediate short-term cash gaps, and the costs are significantly different. MCAs can be incredibly expensive, and their aggressive repayment structures can actually wreck your cash flow, which is the exact opposite of what a true revenue-based finance model is designed to do. So, as you look ahead to the future, the big question is this: which of these funding paths is the right one to fuel your growth? Knowing your funding options and understanding what's available for your company is always the first step to making the smartest possible choice.